What's up? Good morning. Good morning. It is the Bubba Show, or whatever you want to call this. What's going on, everybody? Markets are under some heavy pressure, and again, we can make up any news excuse we want, but news is a bunch of BS. If you trade the news, you're an automatic loser because you'll never catch the news as fast as it happens. The markets are so far ahead of you that you'll never be able to trade off of news items. So it's your job to learn how to trade from the charts. Okay, and of course, this is what we use in our day trading models. We're trading futures, and of course, this morning we traded. We were 5 for 5 this morning, which is always a good thing. But I think you want to first learn to look at the big charts, and when you look at the big chart, you can see all my lines, all my drawings in there. And here we are down at the key level at around, let's say, 43.36 in the S&P. Will it break from here, or will it rally back? And believe it or not, as ugly as this looks, the highest probability is that the markets will pop from here. Now, not necessarily this minute, but I will tell you in the next day or two, you'll see a big rally, and you'll probably see a rally back up to probably close to 4,400. All right. But again, that would be what we would consider or call a dead cat bounce. One thing you have to remember about markets is the biggest rallies will come in what you would consider a market that is that would be oversold. You assume a bounce is coming. I don't recommend that you try to play for the bounce. What I do recommend is that you look and figure out where you would like to be a seller again of that bounce. Okay, I think that's the important thing that you have to look for is where would you be considering to be a potential seller, because right now I would be only a seller of these markets as I would watch and look for the opportunities. I would only want to be someone who was looking to sell these markets. I think we have a lot of room to go to the downside. I think that when you look at the bigger picture, that the markets themselves want to go lower, and I think that this is all we're waiting for now is another potential opportunity or a bounce that would say, okay, we're going to sell it at this level. So right now, I would not be a seller before, let's say, 43.80 in the S&P. Again, is that 100% right? Hell if I know. But I do know that we want to be in that position to be a seller, because we assume, based on the market action, that the markets are going much, much lower. Now, again, that could always change. Okay, but right now the trend is certainly down. The action is certainly ugly, and we are certainly going to be prepared for that side of the trade. Okay, if something changes, well, then we will change, and of course we will look to do something different. But that does not appear to be the case at this moment. I think right now, again, as we watch and we look at the market, we go, okay, so let's consider and continue to play the market the way that it's trending, and the trend is lower. So an oversold market says, okay, so we're going to look to be a seller, and that goes for the S&P, that goes for the Nasdaq. Okay, now Nasdaq still has a little bit more room to get to some support. That goes for the Russell, which is hovering around that 1800, 1795 level. Okay, and the Dow. Okay, those are things that, of course, we would look for, and I think the Dow and the S&P would be the most likely to look to be somewhere it would find a rally. But of course, as I said, we're looking to be a seller of that rally. And I think if you continue to watch, and of course, if you start to look at some of the other markets, you look at the gold market. Okay, gold is probably getting a little bit oversold. Okay, and it is breaking down again. You would look for it to probably come down to 1910, but I would also look to be a seller there as well. I think again, you're playing the overall trend, and I think when you learn to play the trend, okay, you have to understand what is most likely to happen next. Okay, and I think if I look at the charts and go back here, okay, and I go, okay, so I'm looking at the S&P. Okay, so what do I expect to happen next? Well, I know I'm very oversold, and if you're not sure, you can certainly pop up the Bollinger Bands, okay, on any given future. And again, I don't care whether you use them or not. I only use them usually to teach off if I can kind of see that. But you can see that the Bollinger Bands are oversold on a daily chart. Okay, let's just see what they look like on a weekly. Okay, if I can, there we go. Okay, they're getting oversold on a weekly. So again, you would assume and expect a bounce, and you would assume and expect a sellable bounce. Remember, we're anticipating based on the market footprint that you're seeing. Okay, so as I mark these up, the market footprint shows me that the S&P is dropped almost 220 points, which is about 5%. Well, so even a 2% rally would not change the overall trend. It would still be low. But again, it's an opportunity to sell. And the deeper we get oversold here, okay, if we happen to break down even from here, the deeper it gets oversold, the harder the bounce is going to be when it comes. Okay. And what that means to you is that you want to give it more room. Remember this, that bear market rallies have the most vicious movement that make you think that how could I not be in and be long for that movement? Okay. Bear market rallies create dramatic upside movement. But of course, at the end of the day, those are the rallies you want to sell. Okay. You're not looking to buy those. That's a mistake. That's a common mistake that too many people get trapped in, is the buying of a market, okay, that is really meant to be sold. Okay. And that is something that is important to what we teach and what we look at. Okay. Is we have to understand that the footprint that the market's leaving tells you that the sellers are in full control. And what will happen is some buyers will step in, and what we call the weak hands, okay, the nervous shorts, will start to chase the market back up again. While the real shorts, the guys who are really controlling, will be laying them away and selling back to them. Okay. And that's something that, again, we want to always remember as to how these markets function. And until the trend changes, we are sellers. Now you'll hear terms from people out there: double bottoms, buy the double bottom. Well, you don't buy double bottoms in a downtrend. Okay. In a downtrend, you look to sell the double tops. You buy double bottoms in a market that is trending higher. In other words, in rallies, in markets that are going higher, okay, we buy support. In markets that are going lower, we sell resistance. Okay. It's really that simple. Now, again, obviously, not every trade works. Not every trade is right, but let's just see what's going on in the short-term stuff and see if there's any trades we can look at today while we're hanging out together. Okay. And certainly, there was probably a trade I might have missed in gold here. Let me take a look at it real quick. This is gold over here. And actually, we can actually go ahead and play with this a little bit. Okay, now this is a different setup that we're looking at. Okay, and we're going to use a stop at somewhere about 1918 overture. Okay, but again, we can look for that because we have an extension on a sell. Okay, on some heavy volume. So hell, we'll take a shot at it. Again, if it works, it works. If it doesn't, it doesn't. I mean, it's already profitable right now. Now, again, does it mean it's going to be profitable? No. Is every one of these trades going to be profitable? No. But if you're using the proper disciplines, okay, then you're putting yourself once again in the highest amount of probability. Okay, and there you go. So we're starting to pop up here a little bit. There's a fair chance it can reach up to 1922. But since I've got a profit, I'm going to go ahead and lock in part of those profits right now and take all my risk out of the trade. Okay, so I have no risk left. I can only make a little bit of money. Okay, and if it keeps going up, then I'll start to manage my stop. Okay, but for example, right now on one contract of a big gold contract, you're up over $100. You're up $150 right now as we're sitting here. Okay, so I'm going to go ahead and adjust my stop up a little bit and make sure that I lock up more of that profit. Okay, because again, why do I have to sit here and take the overall risk? So right now I've locked in $100 on one contract. Okay, and I'm now out. So listen, take the $100 and I'll move on. Okay. Now, if I was going to be with you longer, I might have traded a little bit differently. But in the meantime, I'm not unhappy either. Okay. Again, it's what we do. It's what we learn from reading the overall footprint of this market. Okay. Crude oil is close. Now, again, if we get one more pop here, we'll probably look at selling some crude oil here as well. Okay. That's, again, I need the volume to get up to here. Okay. If the volume gets through there and the price keeps going up, then I'm going to look at selling. Okay. And taking my shot at it. Okay. Because again, I'm playing a specific pattern here, and there you go. So this is going to be a trade. Okay. Now, what I'm going to have to do here is I'm going to sit here and first of all, let this bar finish. Okay. And see where it finishes. That'll tell me if it's a trade. But at the moment, the high volume and the straight up price movement says that I should be looking for an opportunity to sell this. Now, let's see if it continues. All right, so now we're going to watch here. So here it's kind of peggering out, but we're going to. I apologize. I'm on the wrong time frame. My apologies. Okay, I wanted to be on the 4 minute is my guidance. Okay, versus the 1 minute I was showing you. So I have no trade to make here. But again, it could certainly appear at any moment. We don't know. I would suspect that here we might have an opportunity. There might be a shot here that this could get there. But again, you're seeing the little bit of weakening. Okay, so we've got a couple of minutes. We'll come back to that shortly and look. And let's just go back and see what's going on in our bigger picture here. So the S&P is breaking down even harder right now. Okay. Hey, look, again, I'm already short. Okay. My longer term position is short. In the short run here, I'm not looking to add on. I'm certainly not going to chase them down. If I'm not short, I'm not going to sell. I'm not going to sell them now. This is not the right time. Even if it turns out that it would have been a winner, the whole world is full of woulda, coulda, shoulda. Okay. We're not going to go ahead and jump in at it when a market is under heavy pressure or when it's going straight up, whichever side we're playing. Okay. What our job is, what we're trying to do is we want to make sure that we are putting ourselves in the highest amount of probability. Okay. That is what we're trading, is a probability model anyways. Okay. So we understand that the markets are very oversold. We understand there's a likely shot for a bounce. Let's go back and look and see if anything's happening here. And certainly crude it may give us another opportunity to play. Gold is still going in the correct direction and has not reversed out yet. Okay. You might get, an opportunity, in any product, in any one of these, but we just don't know yet. So what do? We continue to just watch. Okay. You watch the chart. So right now, crude appears to be getting very close. Okay, let me bring you over here. Okay, so crude appears to be getting very close. I need to see the rally to get up to here now. Okay, the volume I got in is good. Okay, that would suggest a potential reversal, but I don't have the price now. The price is already reversing while I'm talking to you. Okay. So there's really nothing I can do at this moment. Now, again, we still have a little bit of time that we could see one last minute rise here. And if we do, then we're going to go ahead and make another trade, right? We've made one in gold, and if we'd have stayed in, we'd still be making money. But hey, that's life in a big city. You know, I can always go back and say if. Okay, in fact, that's the name of one of my companies, coulda, woulda, shoulda. So, you know, I think that you just have to continue to. So this is no trade. Okay, could have been. It could have been a sell, but it's not. All right. So again, we're just on to the next, and we just take a peek. There's nothing active here. So I think one of the things you want to take away from today's lesson is, hey, it's all about the footprint. It's all about the footprint that the market leaves. Okay. Don't think that you know better than the market. Our opinions are not good. Okay. And that includes mine. Okay. An opinion is, you know, opinions are like fill in the blank. We all got one. Okay. You have to just remember that you're purely looking at what is the most likely thing to happen next, and that depends on the time frame that you're trading, because every time frame creates a different activity. Okay, each time frame that you trade, you know, if you want to be very active, you're going to trade, you know, 1, 2, 3, 4, 5 minutes. If you want to be more passive, you're going to use it daily. But you should always be using a secondary time frame that will give you the trigger point. So, you know, for example, okay, if we come back here for a minute. So I'm watching crude again, and here we're getting another little bit of a spike. Now, I don't know if it's going to be a spike enough, but if the 4 minute on crude confirms a signal that I have to do something, I don't make that trade until the 1 minute confirms that it is going to go in the direction that I'm going to go. So right now, as I look at crude, I'm looking for a spot. If it goes higher, my only trade will be short, if any trade. Now, right now, there is no trade for me to make. I would need an awfully big spike in volume here in the next 2 minutes if I were going to make this trade. But provided that does come in, then my next step is to go and look at the 1 minute, and I would want to see a reversal on the 1 minute, because if you remember this, okay, all charts are the same. Okay, all charts are the same. All patterns repeat themselves, and the shortest time frame has to trigger the longer time frames. Okay, a trend cannot start down or up until it starts in the 1 minute. Okay, and then obviously 1, 5, 10, whatever. Again, whatever gauge you want to use. So, in other words, when you're looking at a market, so oops, I didn't want to do that. That was pretty stupid. Hold on, I gotta get my stuff back in order here, otherwise I'll be screwed up later. But if I go back here, so if I go look at a 1 minute chart, okay, and okay, pretty much of a downtrend, right? If I look at a 5 minute chart, a bigger downtrend, okay. If I look at a hourly, a downtrend, so we can see the consistency of the downtrend and how they change, right? And that's just changing time frames, okay. If I go to a weekly, not as pronounced of a downtrend, okay. So that is something that, again, all the charts are always going to be the same because the patterns are going to repeat themselves over and over again, okay. So here we go looking, and again, we don't really have a trade yet. We're waiting. We need a big spike in volume, which we're not going to get. All right, so I already know that by looking here that I'm not going to get enough volume to make a trade, because this trade that we're talking about today and what we talk about often when I make a trade with you is based on price and time, and it's a speed trade. It's a fear trade. It's a FOMO trade. In other words, what we're trying to do is we're trying to take advantage of the emotions of others that are out there. Okay, because as you understand or may not understand, but the business of trading is very emotional. Okay, and it is our job to catch those who get too emotional on either side of the market. Okay, so that we can take advantage of that. Okay, that is purely exactly what we're trying to do. We're trying to take advantage of the information that others are panicking on or puking off of. Okay, it is that simple. Again, not that it's not that trading is simple, but identifying the opportunities for yourself should be based on price and time, and whatever this your secondary time frame is going to be, because we have different time frames that we can operate off of. Okay, and our different time frames are simply that we can simply put ourselves in a position. Okay, and realize that if we're following the market footprint, that we are in an advantageous position. Does that guarantee a win? No, it does not. Okay, all we can guarantee is that we have an opportunity. Okay, that is our only potential, is that we want the opportunity for the market to be to our favor. Okay, and for us to have benefit. Okay, if we don't get benefit, then we don't make the trades. It becomes back down to, again, those simple words, that it's kind of that simple. If we cannot find a benefit, okay, or an advantage for ourselves, then we don't make the trade. Okay, that's really what markets come down to, is the ability to read this. And of course, right now we don't have enough action, so we can see clearly that there is not any true emotion to the market right now. There is nobody that's really forcing the market to do one thing or the other. We're kind of right now just in what we would think of a drift mode. So as a overactive trader right now, we would not be there. We would not be looking to be extremely active here. We would be sitting here waiting for opportunity. Okay. And right now, again, under the short-term trading window, there is not a dramatic amount of opportunity. So you can choose to sit here and watch this, okay, or you can choose to say, hey, I'll come back later. That is entirely up to you, okay. As normally in the morning, I'll trade with my members for an hour. Today we traded for 30 minutes, had 6 winners, and we're done. Okay, so again, there's no reason to push it or force it. Again, I just got to wait. And if the patterns don't show, then they don't show. And if I go back to our longer time frame again, here we go. So we are continuing to try to break lower here. Now we're not going down at any real speed. We're not seeing anything that's dramatic. Okay, we're not seeing anything dramatic in the the Nasdaq. Now you can bet that the Nasdaq will probably have a little bit of a bounce off of 14,650. It doesn't mean it won't close lower, but a little bit of a bounce is probably coming. The Russell is still just hovering right around that 1,800 and below, and the Dow again is breaking down, very much like the S&P. So again, at some point here, there will be a rally or an attempt to rally, and hey, you'll be ready for it if you're watching. And if you're not watching, it means you're not taking any risk. Okay. So again, here we look back at the short term. Now again, you don't expect anything major to happen right now, because there's no volume even in the short term. Okay, this is what we have to watch for, is that there's not even any volume in the short term here. So why would I expect anything else to happen when I don't have any real action in front of me? Okay, remember, that's what it's about. It's about understanding the probability model, which is a chart. And all the chart is a geometric progression. Okay, it gets too expanded, you're gonna look for it to go the opposite way. If it sits there and turns and does nothing, I mean, there's other ways to trade. Okay, you could certainly say, okay, well, I'm going to look for resistance here, so I need a rally. I could call this support, maybe try to trade the channel. But to me, that becomes too complicated and too subjective. Okay, I think that traders that try to trade subjectively are more often and more likely to lose. I think that it's easier to have a reason to make a trade. And I think the other thing that you have to always remember is that you want to use a model that gives you an exact set of rules, okay, to make your next trade. Okay, there is no purpose in trying to use, an opinion or your anything else. Hold on one second. Hold on one second. I think there's some other business. Okay, so again, you have to have a reason to make the next trade. Okay, what is that reason? Well, again, I use the panic trade in the short term. I use the trend for the long term, and I recognize that markets are due some sort of a bounce. Now, will it be today? I have no idea. I will tell you by Thursday when we talk again, the markets will have had a pretty big spike rally at some point between now and then. Okay. Now, if you remember last week, I told you that the VIX would trade over 18. Well, there it is, 1850. Okay. And again, it's not that I'm right. It's just you learn to watch certain things in these markets that then give you a better handle. Oops, I should have shared that. There you go. Okay. That you want to watch certain things so that you can share and see where the opportunities come from. Okay. Now, again, if the VIX continues to push higher, you're going to assume that rally's not coming. But what I would start to watch for is for a falling market and a falling VIX. That would indicate the markets are probably getting ready to turn. Okay. Again, that's no guarantee. That is no absolute. But though, again, you have to make certain assumptions in any market, okay, as you watch them, because again, this is what it comes down to. It comes down to our ability to make logical assumptions based on current market activity that will then give us a greater opportunity of success. Okay. And again, it's purely, our business is purely about understanding the reading of a chart, the speculation that comes along with it. But again, using the tools, even the tools that we're learning together here, which is just simply markets will do what usually means go in the path of least resistance. So if they fire down, that means that there's a more likely need for a bounce. And again, you're trying to read the competition and the emotion on the other side. And I think if you learn to do that and you learn to have the discipline to sit back and do that, I think you'll be much more successful. And I think you'll be a lot happier as a trader because you will have a reason to trade. You will have an exit to use to get out so that you never have to use any subjectivity to the trading world. In fact, we prefer to really trade more like a robot, okay, that every decision is kind of automatic that shows up. And if, we're looking here, like if we would have gotten a chance to sell crude, which we didn't, again, life is what it is. I don't always get what I want. But if we'd have gotten the opportunity to sell it, it'd have been a winner. Okay. Our gold trade was a winner and we got stopped out. Fine. We're coming back into it now. And again, these are just things that you're looking at, okay, as the world. Okay. This would have been a winning trade had we been able to get in, but we didn't. So, okay. On to the next trade. That is really what it comes down to. So we'll be back on Thursday. Okay. Same time, same station. If you have any questions, feel free to send them in. And if you have a subscribe right below, okay, make sure that you get the notifications. So when we go live, and make sure you remember Tradier brokerage, because I got news for you. I have them all, but there ain't nobody better than Tradier. And certainly from a finance standpoint, you want to have Tradier brokerage. Have a great day, everybody. We'll see you back here on Thursday. Be careful, be good, and we'll see you later.